I'm Alex Mozet, and welcome to Winner Take All, where we talk about the constant battle to fight back and win against big tech monopolies. A few great topics today. Sequoia has announced what they call a crucible moment. This is a game-changing moment, as Sequoia would describe it, for the venture capital industry, taking a classic knock against VCs not being able to innovate, even though they're investing in all this innovation. They believe they have found that truly disruptive model. We're going to talk about that. And some of the interesting parallels that I think it shares with AngelList. Rent the Runway is public, not a platform. Stock is not doing so hot. We're going to dig into that. And then there's a couple themes here around this convergence between linear e-commerce and marketplaces. And how can even just linear businesses and platform businesses work more closely with one another? I got a couple examples of marketplaces around retailers, around then value-added services into marketplaces. And I think, it's a really great perspective of seeing how both sides of the aisle can work together to both benefit their own respective models and share synergies. So first topic is the Sequoia news. The Sequoia Fund, patient capital for building enduring companies. Ironically, innovations in venture capital haven't kept pace with the companies we serve. Our industry is still beholden to a rigid 10-year fund cycle from the 1970s. It's actually not even everyone even has a 10-year fund cycle. Sometimes VCs have like a 7-year fund cycle. Why Sequoia has an issue with that is because they say 10-year fund cycle has become obsolete. They talk about examples where it just takes a long time for these large tech companies, many of them platforms, to reach critical mass to get that winner-take-all scale. In recent years, many of our most promising companies have chosen to stay private longer, building scale and expanding their strategic footprint before debuting as public market leaders. They then compound their advantage for decades, with much of their value accruing long after an IPO. Square, for instance, which we partnered with, that means they invested, in early 2011, had a market cap of $2.9 billion when they IPO'd in 2015. 5 years later, Square grew to $86 billion and today is worth over $117. So there's a little chart, not in this article, but in this article. This is from PitchBook, where they do a good job saying, Sequoia portfolio companies with most valuation growth following IPO. This is to put some numbers against Roloff, who's one of the main partners there at Sequoia. So for Meituan, they exited. This is actually their biggest, their biggest home run. Meituan Dianping in China, food delivery and ride sharing space. Exit value of $48.6 billion. Current market cap of $226 billion. This is the exit value when they IPO'd versus the current market cap. So, IPO'd at 48.6, now worth 226 billion. ServiceNow, IPO at 2 billion, now worth 136 billion. Square, this was the example Roloff gave, 2.7 IPO, now worth over 120. Snowflake, IPO 29, now at over 100 billion. Zoom, IPO at 8.9, now over 80 billion. What Roloff is saying, hey, a lot of these companies are staying private longer. We've seen that huge influx of, hedge fund capital and growth stage capital to put massive fundraisers into these companies before going public. Then once they do go public, they still have, many years to take advantage of the competitive advantage that they've built. A 10-year fund horizon limits Sequoia's ability to, as they would say, act as the best partner with the tech startup, but also, somewhat more importantly, to get the best return on their money for both themselves as GPs, as well as, for their investors, their LPs. So what is Sequoia proposing to do? They have now said that basically we are going to have one massive fund. We are breaking with the traditional organization based on fund cycles and restructuring Sequoia capital around a singular permanent structure called the Sequoia Fund. And basically, our LPs will invest into the Sequoia Fund an open-ended liquid portfolio made up of public positions in a selection of our enduring companies. The Sequoia Fund will in turn allocate capital to a series of closed-end sub-funds for venture investments at every stage from inception to IPO. Well, I'm going to break that down, so don't worry. Proceeds from these venture investments will flow back into the Sequoia Fund in a continuous feedback loop. Investments will no longer have expiration dates. Our sole focus will be to grow value for our companies and limited partners over the long run. So what does this mean? Basically, if you are now an investor in Sequoia, you are not invested in Fund 1, Fund 2, Fund 3 that has a specific strategy that's focusing, on a specific vertical or a specific theme, etc. You are now just instead investing into one massive roll-up called the Sequoia Fund, and you can exit and enter that fund with Sequoia having to worry less about when it's going to exit its positions in particularly its private investments as a result of its investors coming in or coming out of the mega fund, right? Obviously, there's a lot more detail to it than what they're disclosing here. But what this is doing is this is giving their portfolio managers that are managing the closed-end vertical specific funds. Those aren't going away. What they're changing is the capitalization structure, essentially, of their closed-end vertical specific funds to say, hey, you know what? Fund manager, we just want you to get into the best companies. And oh, by the way, with this positioning on Sequoia Fund and not having a 10-year time horizon, this should be a differentiator for Sequoia in the market with the tech startups, right? Because now Sequoia can say, we're the best partner. We're here for the long term. No one else has this fund structure. Or is it no one? I'm going to get to that in a second. You should choose us, not anyone else. Hey, fund managers, just do your job. You don't need to worry about timing the exit. When is the best time to exit your position in the company? What happens, right? You go raise a fund. You really got to deploy that money somewhat fast first couple of years, because then, the way you do your fund is you make your initial investments and you got to get those out in the first couple of years. And then you save a good chunk of your capital for follow-on investments, right? So you say, I put money into 10 companies. These few are doing really well. Let's put more money into those, and then some of the companies aren't doing as well. And then you don't continue to invest. You just try and get your money back from those that aren't doing as well. So you're then doing follow-on investments after the first couple of years. And that's kind of the cycle. Sequoia is now removing the pressure, the time horizon pressure, and just saying, let's get into the best companies. Let's continue to support the best companies and obviously put more money into those companies. But we don't need to worry as much as saying, oh, well, this company isn't going public as soon as we'd like, or now that they are public, we have to exit our position because our LPs want to, get all their money back. Now they're kind of extrapolating away a lot of those kinds of issues or concerns or pressures for the reasons that that Roloff has laid out here. So basically, yes, Sequoia is trying to act like their namesake, a Sequoia tree. If you're not familiar with the Sequoia tree, these things are massive. These things are huge. And they can actually live to be 3,000 years old. So really trying to live up to the ethos of the longevity of the tree and remove these timelines from their investing horizon, which is interesting because there's another company which has put a really interesting model together, and that's AngelList. So if you look at AngelList, they're an investment marketplace first and foremost. They're also a recruiting, job site as well. There's a bunch of cool things they're doing with the tech startup community. They have started as a tech startup, but have been profitable for many, many years and are just doing a bunch of really cool things, particularly around capital, but around hiring as well. But this thing's called their rolling fund, which is a new concept. So Fundraise publicly and continuously. Your LPs subscribe quarterly so you can accept new capital and never need to raise another fund again. So there is this concept. Now AngelList could have some negative stereotype. Oh, it's an investment marketplace. It's not as private and exclusive as a Sequoia, which has all these personal relationships and not everyone can get in, right? All these kinds of things. There is the same concept of not having a fund horizon. For them, they're saying, hey, you can just have a rolling fund. Investors can just continue to invest. And you never need to raise another fund again. So it's just evergreen, which is somewhat similar to what Sequoia is talking about. Doesn't have as much of the gravitas and we are Sequoia branding around it, but similar theme in terms of an evergreen fund that investors just pool money into one entity, and then that gets split up based upon really when investors entered the mega fund, right? So I would imagine the way that Sequoia is structuring this is similar, because you have investors come into the Sequoia fund, the mega fund, the meta fund at different time horizons, right? So how do you split up the proceeds? And I think that Sequoia looked at what AngelList has done with the rolling fund model, as a way to certainly inform some of their thinking. It's a little bit different what they're doing, but there are a lot of similarities here. It doesn't talk as much about the thing never expiring as Sequoia is putting the emphasis on it, but again, a lot of similarities. I am bullish, optimistic about what Sequoia is doing. Clearly, these VCs needed to do something with the just huge influx of other capital that's come into the tech startup investing foray. And so I like that they are leading the charge and at least trying something and doing it in a pretty big way. Last note, which they touch on right at the end of the article, is that we are also becoming a registered investment advisor. And this expands our flexibility to support portfolio companies, yes, through various financing events. It also enables us to further increase our investments in emerging asset classes, such as cryptocurrencies. Interesting. So now they can go, is Sequoia becoming a crypto investor? That could be an interesting way to just park some cash. If they've got cash, just sitting around waiting to be deployed, maybe now they can just go park it in some emerging altcoins, because now they have full discretion. They can do whatever they want with that money. Right? They've basically said, we are not going to tie our hands to how we deploy this money. If you are giving us money, Sequoia Fund, you give us full title to basically do whatever we deem appropriate with your money. That's kind of the new Sequoia pitch. See how it goes. Okay, next topic is the Rent the Runway IPO. Rent the Runway, say that 3 times fast. Just went public in the past week or so. Opened at a little over $19 a share, is now down, roughly 15%. There's been a lot of hype on this company over the years. A lot of hype, a lot of kind of glitzy names around it. And so now we kind of get to see what the goods are around it. Here's the information's article. No profits, no growth. Rent the Runway valuation hinges on hope. Yikes. Got some teeth here. A little surprising from the information. You would think they would have softened it a little bit, just kind of given the ilk surrounding the company. The pandemic has not been kind to Rent the Runway, sending revenue falling 9% over the first half of the year. Company goes public on Wednesday after pricing its IPO at $21 a share. So it priced it at 21, it opened it in low 19, and now it's actually even down more than 15% if you peg it to the $21. Its revenue was $158 million, so almost a 10x revenue multiple, and the company is not profitable, losing $84 million in the first half of this year. Oh, yikes. It's now probably in the, I don't know, $700 to $800 million valuation. You take its current share price in the mid 16s. Not a platform business. What they do is they buy inventory and then they rent it. You get dresses and other kind of, fashion clothes. If you're going to a party or a wedding, you don't want to spend $600 on a dress. You can rent it for, I guess, like $200 or $150 or something like that, right? Kind of, I feel like Rent the Runway needs to have a couple turns of the inventory, because they're not buying it for retail if it's a $600 dress, but the couple turns of the inventory, and then hopefully they're paying back that dress, if not making a little bit of money. Once you probably get to 3 or 4 turns, then they're really making good money on the kind of per item basis. But it's not a platform company. The inventory is on their balance sheet. It's a really difficult model. I've always thought that this would be a company that should be trying to embrace a platform model, right? How can it get into, for example, there are these companies. This one, I don't know how they're doing. This one's doing bag, borrow, or steal, which is renting like designer bags, for example. Not clothing, where kind of weird to like rent someone's clothing and then give it back to them, right? That doesn't really play the same. But this was an interesting one that if you look at this company as another example here, which is not formally a rental company, right? This company, Rebag, they've raised $100 million in capital over the years. They just raised, kind of a couple times here during COVID. They raised in May of last year, 2020, at $120 million valuation. They just raised another round at $26 million in May of 21. It's secondhand, e-commerce, so sales, buying and selling, which we've covered a lot on the show. How, secondhand clothing and fashion marketplaces are all the rave and are actually becoming their own industry. Rather than, there's new and then there's secondhand. And I think this is actually the dawn of an entire new industry, which, you would have hoped that a Rent the Runway would have been on that cutting edge, right? Like, why isn't Rent the Runway capturing the secondhand industry? They've been like the marquee kind of secondhand company, founded, I think, back in like 2009. So been around for a long, long time. Really haven't seen much business model innovation out of Rent the Runway, frankly. You'd think that they would have been able to try some things if they're burning over $100 million a year. This year, burning $80+ million in the first 6 months of the year. That's a heavy burn. So you'd think you'd have some cycles to kind of do some business model innovation. Now, here's the cool thing though, right? So this is on Rebag. Now, so this is on the left here, sell your stuff, get a quick offer. So they're gonna actually buy it and then resell it, genius, and use their AI to like give you an instant offer. Love that. And then look at this, Infinity Exchange. Turn in any Rebag purchase within 12 months for credit worth 70 to 80% of its purchase price to put towards your next. I love this, right? I love this. It's saying you buy something secondhand on the site, you sell it back on the site, we'll give you, say, 70% of the value as a credit, and then you're going to recycle that money back into the platform, right? So as long as you're buying stuff that is holding some of the value, you're not buying like Zara that's going to go bad after you wear it 2 times, but you're buying stuff that retains some amount of the value. You're already buying it secondhand, so it shouldn't have a huge drop off in price unless you've really tarnished the thing. But I'm sure they've got like a quality control mechanism in here. This Infinity Exchange program is basically renting, but not called renting, right? Sell it back within 12 months. Interesting. Get a credit. I mean, it's basically renting. But they put the onus on you to put it back into the platform if you don't want it. Yada, yada. I love it. It's basically a renting angle, not calling it renting, recycling all the money within the platform. So has really good lock-in. These are the kinds of things, right, that I'd want to see from a Rent the Runway. These are the kinds of things that if I'm looking at a linear business, which has good tech, good digital, but is hemorrhaging money, growth is like non-existent. They're actually down on growth and blaming COVID because people aren't going out as much. But people aren't going out as much, but secondhand sale marketplaces are booming. So rental is down, but where is the secondhand kind of e-commerce buying and selling play? I mean, this is Rent the Runway site, right? The power of renting. They're all in on renting. You can get a membership. Want a one-time rental? And they're just so stuck in their model. I mean, these guys were high flying in their first 5 years, right? Like they were the darling child of the tech media hype bandwagon. And then they've kind of fallen out of vogue. I do think it would have better served to try out some business model innovation. I'll rental all the way, but I would not put money into this, say that much. Okay, next topic. So this one I really like. Marketplaces enabling retailers. I've talked about this, how there are smaller, up and coming, literally I was just talking about secondhand marketplaces becoming their own industry, right? So we've talked about how secondhand marketplaces and manufacturers, brands are partnering and leaving retailers out in the dust. Where are the retailers? What are the retailers doing? How can retailers benefit from marketplaces that could be selling new stuff or used, right? Secondhand stuff. The answer is many ways. And who would have thought, in terms of business model innovation, JCPenney is my example for partnering with a marketplace. Look at this. JCPenney taps a B2B online portal, it's a marketplace, to grow sales of beauty brands. JCPenney has joined with Landing International. This is a baby startup. By the way, I'm going to talk about it more in a second. A B2B online marketplace for the cosmetics products industry to provide a one-stop shop for beauty brands looking to break into large-scale retailers. Landing International gives smaller beauty brands access to large-scale retail integrations and consolidates sourcing and logistics. Instead of working with multiple beauty manufacturers, JCPenney works directly with Landing to meet its assortment planning, inventory planning, and training needs. Love it. What asset does JCPenney have? They have demand. They have scale. They have audience. What do consumers, irrespective of what kind of consumer you're talking, what do consumers want? They want more choice and they want good prices. What did Jeff Bezos say? I know consumers are always going to want stuff cheaper and they're always going to want more selection, right? Like these things are pretty hallmark, wholesale, foundational truths. And so JCPenney has partnered with this literally baby startup. There's like no funding information on this startup. I hope that JCPenney has equity or warrants or something with this startup. If they did not, that is a huge mistake for whoever is negotiating this deal. But how can you partner with a marketplace to do what? If you are a retailer, if you have e-commerce, if you have demand, how can you partner with a marketplace to give you better supply and good prices? And this is a great example of doing it actually in a somewhat analog way. It doesn't even sound like this is integrated directly into the JCPenney e-commerce experience. This is just something that the JCPenney buyers are going to be using this thing to buy and then stock stuff and put it onto the e-com site or put it into the stores. So this is a super analog integration. This it doesn't seem like it's even digitally enabled for the e-commerce site, right? There's a portal for the JCPenney buyers to use. It's a great baby step example. This is a very seemingly, not too much of a lift type of partnership for JCPenney. And JCPenney ended a merchandising agreement with cosmetics product merchant and brand Sephora. Sephora terminated its store within a store agreement with JCPenney and moved over to Kohl's. And then JCPenney has now done this deal with Landing, which I really like this deal. Now, this is just one example. If you are a large retailer with a strong e-commerce presence, what have we seen recently? We've seen activist investors go after Saks to try and decouple the e-commerce site from the analog store part of the business. Same thing has now just happened with Macy's. This partnership that JCPenney is doing is going to impact both e-com and analog store, right? JCPenney's ability to negotiate this deal, I don't know how good of a job they did negotiating, but their leverage is a lot stronger when touting both physical retail and e-com, right? That's a much better negotiating standpoint for a JCPenney, for a Macy's, for a Saks, for a Meyer, to negotiate with these marketplace startups than if it's decoupled. But the problem is that these retailers have not really shown any true marketplace innovation to warrant them kind of keeping both entities attached, right? I mean, what has anyone besides Walmart really done to move the needle? Even Target has been slow and sluggish with their expansion into marketplace. They bought Shipt, haven't really heard much about what's going on with Shipt, even though it looked like a great deal on the surface. Haven't really heard much about what's going on with that. There are very fringe examples, but there are so many small to mid-size, and there's certainly large ones, these marketplace startups selling new goods, used goods, a whole spectrum of, products, secondhand product, that they need scale. And everyone's getting crammed down by Amazon and now to a certain extent Walmart. Why aren't large retailers that have strong e-commerce businesses sucking in the inventory and expanding the supply and product catalog and getting better pricing parity by doing partnerships with marketplaces that need scale? Those marketplaces will give you inventory, will give you better pricing capability, and you don't need to then deal with all the hassle of running your own marketplace, having to launch all your own third-party seller recruitment and management program. Let the marketplace handle that. What are you retailers good at? Having a consistent brand, curating the product selection, and you can work with these marketplaces to do that. This JCPenney deal is a great example of them doing it in an actually very low-tech manner. This is the lowest of low-hanging fruit. There's so much opportunity in this space for retailers to work and partner with smaller up-and-coming marketplaces. You just haven't really seen much of it. So if you're not going to do anything with your e-commerce site that's innovative, then yeah, you do deserve for it to be broken off and given to more savvy management. But this is a great example. I love this example. Now, running that script in the other direction, marketplaces are capturing more and more demand. And how can other linear providers leverage that opportunity, right? So instead of marketplace integrating into linear, how can linear integrate into marketplace? We've got a great example to highlight exactly what I'm talking about. And that is this. Just unfortunately, the linear player is enabling the devil that is Amazon. Next Insurance targets businesses that sell and buy on Amazon. So this is a kind of new up-and-coming insurance provider called Next Insurance. The insurer is targeting members of Amazon Business Prime that use Amazon as their procurement hub. We believe Next Insurance offering products to Business Prime is another example of how this program provides value and benefits to members. Business Prime members can obtain Next Insurance quotes and then purchase general liability, professional liability, workers' comp, commercial auto, and tools and equipment coverages. In cooperation with Amazon, Next Insurance is offering an exclusive 10% discount on general liability and professional liability policies. Next Insurance has raised a lot of money, over $800 million, has most recently raised $250 million in March of 2021 at about a $4 billion valuation. CEO of Next Insurance says, "We believe the future of the insurance buying experience involves meeting customers where they already are, marketplaces, making it easy to purchase customized and affordable policies." Now, here's the other part. So the insurer is also targeting businesses that sell goods and services on Amazon. Amazon requires certain sellers with gross sales of $10,000 a month or more to have insurance. The insurance requirements for sellers, known as Amazon Pro merchants, includes $1 million in liability coverage. So now this is a really cool part. On the purchaser, on the consumer side of Amazon Business, yes, you can sell to these business customers like Applico professional liability insurance, general liability insurance, give them a little bit of discount. It's more of like an affiliate type of relationship between a Next Insurance and an Amazon, right? It's very, very, low lift to do something like that. Now, on the supplier, on the producer side, it gets even more interesting. This is where you can start to do like what I call embedded value-added services. And what I mean by that is you can actually start to have an embedded, say, insurance policy as a part of the marketplace model, as a part of the onboarding experience for sellers who are doing certain volumes on Amazon business, right? On Amazon, selling a certain amount of stuff. Now you can have a much more integrated and specialized value-added service in this case being insurance, for these sellers. That's where it gets really interesting, right? Meeting as the CEO of Next Insurance says, we believe the future of the insurance buying experience involves meeting customers where they already are and making it easy to purchase customized and affordable policies. Literally, I think what he's really speaking to are the sellers and having a really specialized, embedded insurance offering. Now, it doesn't just stop with insurance. Again, linear service providers meeting customers where they are. Where are they? On marketplaces, more and more and more. And providing, what does he say? Customized and affordable, fill in the blank, value-added service. Could be insurance policy, could be financial services, more around financing, could be shipping and logistics, right? What are the key things, what are the key value-added services that every marketplace wants to bolt on once they get to a certain level of scale? It's simple. Shipping and logistics, fulfillment, and financial services. Payments, financing, insurance. It's literally the same script. We've seen it now for over 25 years. Those are the two key buckets of value-added services that every marketplace, once they get to enough scale, they try to make their value proposition stickier, try to get a little bit of extra margin. And how can linear service providers rise to that challenge, that opportunity, and create this customized, what we call embedded value-added service integration into marketplaces that have more and more customers coming to them, both on the demand and supply, the producer side of the marketplace. Now, doing this with Amazon, the devil, juggernaut, monopoly, you don't really have much leverage if you're at Next Insurance. Where I think it gets really interesting is saying, how do you do this with the unicorns, the single-digit billion valuation marketplaces that haven't really spread their wings, don't have as much leverage to cram you down, right? Next Insurance is, I think, probably doing this at break even, if they're lucky, with Amazon, really to try and probably build the name and they're probably betting on the come, saying, well, I'm just viewing this as a customer acquisition play, and I'm gonna make my money when I sell the next policy to these customers, right? Amazon is cramming these guys being Next Insurance all the way down. But to me, if I'm Next Insurance, my play is now, how do I take this similar model and go do it with the next marketplace, right? Where maybe now I can point to the Amazon example, I can point to all the money I've raised, my $4 billion valuation, and I can now take my learnings from Amazon and now actually start to make money, but do it with a marketplace that's up and coming. Still doing a lot of scale, but not at Amazon level scale and leverage. It's a huge opportunity. I would much more so see it with the up and coming marketplaces to enable not the big bad tech monopoly that's Amazon, but a very valuable lesson and pattern for us to spot and then take advantage of. That's it for us on Winner Take All. Thank you so much for joining us. I'll talk to you soon.